Oops, let me go ahead and jump back here. Just 1 second. Okay, so thank you very much for joining us. This whole system is built to, in the safest manner possible, protect and grow your capital. Okay, and I really think the more and more I look at this program, the more and more I follow it and try to understand it more. I really honestly realize that really the core methodology is built around Warren Buffett's #1 and #2 rules. Okay, rule #1, never lose money. Rule #2, don't forget rule #1. Okay, just a quick little touch on what we're going to go through today. We're going to do the trade alert. It's always important to let you all know why we engineered the positioning we did today. Okay, and just really, if you all have any questions on why we've engineered or what we're looking at in the macro atmosphere to position in the way we have, please feel free to jump in. We will have a lot of information in a very short period of time, but please feel free to just jump in, unmute your microphone, or just type it in the chat box, or simply wait to the Q&A session about 30 minutes from now. Okay. #2, we're going to briefly touch on the news today. Not quite as much. There's just not quite as much news in the markets this time of the year. But definitely we'll touch on what will drive price action today and tomorrow, but an abbreviated version of that today. #3, we're going to do questions from our audience. Okay, this is your chance to ask any questions you may have. Please write them down and ask them live with us. It's a phenomenal way to interact and get white glove customer service. Unmute your microphone and get live answers from our team in regards to anything on your mind. The 4th thing, Jason will pass the presentation back to me. We'll cover what we provide for our clients. Okay, and so just a couple of things that you're going to need in place to get the most value from our service. Okay, so brokerage account set up to follow our trading plan that has option trading enabled. You can use real capital or simply paper trade. Then you can see how incredibly easy it is to give your hard-earned money the protection it deserves. Our minimum allocations will need $75,000 for the full system and $35,000 for the light system. And there's a couple different options you can pick there, but if you want to have the most protection possible and the best structure possible in your portfolio, we always recommend that $75,000 tranche. Okay, and I'll touch on what that covers in just a minute here. #2, you're going to need the ability to take 1 to 2 minutes to follow our trade alerts released daily at noon Eastern. Okay, these trade alerts are by no means time sensitive at all. They simply need to be placed before the market closes at 4 p.m. And I'm actually going to, just the last couple of days, I've actually started to take the time to just wait until after the presentation to replicate my engineering. So just kind of a heads up, I'm not to the second following this by any means, and will never be, just because of how liquid the positions we trade are. Okay. #3, a mobile phone to receive our text message trade alerts. Many of our clients take these trades on the go, from the airport, restaurant, in the car, anywhere you have service. It's important to make sure you entered your cell phone number when you signed up for the trial. If you used a landline, email the cell phone number to ryan@portfoliobuilder.io, and we'll make sure to add the correct number to our distribution list. That way you can get the text messages. Super critical. And I absolutely love the user side of being able to get a text message and replicate what we do on the fly. An email provider that's in good working order. We send out the free daily webinar invite via email, and we also send out the trade alerts via email on top of the text messages. Okay, and a couple things that will be provided to you at no cost during your trial. #1, the trade alerts. That's going to be where you're going to be able to protect your capital and really be able to give it a layer of security you've probably have never even thought about or tried to engineer. The alerts are sent via text message and email each day, Monday through Friday. And obviously, we're going to have a little abbreviated schedule here with the holidays, but we engineer our positioning in coordination with the financial system and macro environment. We watch the market 18 hours a day, 6 days a week, so you can enjoy your time. couple of things. We trade SPY Monday, Wednesday, Friday. We trade the EEM Tuesdays, which we'll trade today. And we trade the TLT and GDX on Thursdays. Okay. There's going to be a daily live presentation with the live chat to ask questions. Okay. And live Q&A opportunities every single day. It's something that a lot of people in the industry don't offer, and we absolutely love to deliver that. So one other thing I like to touch on really quickly is I recommend people follow our trading plan with 300,000 to start. That way you can make our 1% target return really pay off during your 14-day trial. Over 30% of our existing customers have paid for more than the cost of the annual membership by using that amount of capital, some using more. But it's just a great way to be able to pay off the service before you even have the cost and your trial's over. To make your life easy, just remember for every 100 shares of the SPY, you'll want 200 shares of EEM, TLT, and GDX. It's best to only buy the shares the same day as a trade alert is released. You don't want to just go out and buy this portfolio naked, okay, by any means. You want to wait till the trade alerts come out. That way we can add an extra layer of protection with the option positioning. Okay. And as always, call me if you do have any questions. My number is 505-322-7515. And Jason, I'm going to go ahead and pass it over to you here to start up the core part of our daily presentation.
Great. Thank you, Dean. Excellent. All right, guys, here is our trade alert today. And essentially, I have a pretty simple prediction for the start of 2020. And it can be really explained very well with this chart I'm going to put up. And it's odd, but we're seeing that during periods of quantitative easing, when the Fed is purchasing bonds, we're actually seeing yields rise. And this is due to banks getting freed up cash in their balance sheet, which they're turning around and lending out to hedge funds who are leveraging up on equities. So almost like clockwork, we're seeing the long end of the Treasury curve rise during quantitative easing, and at the same time, equities rally significantly. And so this has been done in QE1, QE2. Operation Twist was a little different, just rearranging their debt. And now we're entering a new period of quantitative easing. And so the big picture is that the US government is creating tremendous amounts of bonds because they're not creating enough tax revenue to finance the government. And as long as we have these huge deficits, we're going to have the same problem and solution. And the problem is there's too much spending. The solution is to sell bonds. And this creates a situation where we either have trouble funding the US government, or the Fed has to step in and essentially purchase bonds, which expands their balance sheet. And that's why we're so bullish on stocks, not because of any kind of good reason, but essentially because the US government is forcing the central bank to expand its balance sheet. And so that's the big picture right now. I have some other charts we'll look at in a little bit to go over this in more detail. But essentially, I think stocks have a free pass as long as a few circumstances are met. Number one, China has to play nice. And the news this morning is that they are rolling back a whole bunch of tariffs, primarily related around agriculture. So that's a good sign. We're expecting their Premier Liu to fly out to Washington to sign the phase 1 trade deal. Whatever exactly is in it, 155 pages. And so as long as that continues, I believe we'll see this repo madness continue to grow as the debt levels are just growing faster and faster. So my prediction is the SPY will go up at a faster pace than many people will believe possible. I'm thinking of the 1999-2000 dot-com melt-up sort of experience. And so we're getting way past earnings. It's just we've gone into this world where interest rates are at 1.75 in the US. And most likely we see stocks fly up, a sell-off in the long end of the Treasury, until that breaks the stock market and forces the Fed to essentially drop interest rates and start purchasing different portions of the yield curve. So we'll take a look at that in a moment. Here's our current trade alert. And as you can see, it's an interesting setup with volatility cheap and the expectation of a melt up in equities. We can design quite a lucrative trade. And so in this trade, we will outperform slightly, just ever so slightly, the SPY in terms of just buy and hold, as long as we do get some pretty significant moves to the upside. But on the other hand, when we do get little bouts of volatility and the SPY were to sell off, we have a sharp cutoff of $1 loss. So we essentially have an unlimited upside potential with this trade, which does cover us through Friday. But on the other side of the trade, we have a limited downside. So this is only possible when the VIX is cheap, and we do forecast some pretty substantial moves to the upside. So this is kind of like our loose option collar, except it's better designed for melt ups to the upside. If we thought we had a just slow sort of flat to up move, the loose option collar would be better. And also if we thought there was limited downside risk. Now, because of how elevated these prices are, I sure think there will be plenty of days of volatility. But in the big picture, I'm suspecting a melt up in stocks. And so we've been predicting this since the phase one deal was announced in October. And then if we did get a phase one deal, the next target, it'll be hard to exactly predict where the top of the SPY is, but I think the better indicator to call a top in the SPY will be from studying the 10-year treasury. And so we'll take a look at that chart in a moment. To review today's trade and go through each piece of it, the first step, let me pull up the trade alert so we can look at that. So we did pull 12-cent profit on the previous trade. And again, to calculate that, you want to track two things. Number one, what was the change of price of the SPY when you entered the trade and exited the trade or rolled it over? And so in this case, the SPY went from 321.27 to 321.56. And the options cost a debit of 22 cents and paid back 5 cents today. And so we profited 12 cents. Now, where we underperform with this strategy is when we get a weak move in the SPY. So the SPY did go up about 30 cents, and we only were able to harness 12 cents of that. But the reason why is we had extreme downside protection. So we have very little risk to lose money on a sharp sell-off in this current setup, and we really benefit on these $1, $2, $3 moves on the SPY. So if you've watched us for most of 2019, we've been on the other side of the stick, picking up nice returns, but not able to outperform the SPY on the big melt up days. And now that this China fight is at least at a ceasefire for the foreseeable future, and we have rates that have been cut 3 times, and we also have quantitative easing. This makes our job to predict a melt up in stocks and a lot of trouble for underpriced treasuries pretty clear going into 2020. So let's take a look at how to get out of the last trade and into the new trade. Your put option was worth a penny today, so we're going to let that expire worthless. Now, we do have to always purchase back our short call option. So the first step, if you did take the previous trade, is to buy to close the December 23rd 321 call and to sell to close the 322 long call. So we were short one call option and we were long the other. So buy to close the short 321 call expiring December 23rd, and then sell to close our long December 27th 322 call. So we get a net credit of 5 cents. Now, immediately after placing that trade, you can roll over into the new trade, which is again, a trade that will cover us through Friday. And it's a very similar setup. We're selling the 322 December 27th call option, and we're buying the 321 put. So if we ignore the third leg of this option trade, let's just talk about what each of these legs mean in relationship to our position. So I'm going to zoom in on this so we can go over it in detail. When we sell the December 27, 322 call, we're taking in a credit of 64 cents. Now let's look at the math on this. The last trading price entering this trade was 321.55, and we're selling the 322 call option. So if the call option buyer, who we've sold this call option to, exercises his right because the trade has gone in his favor, let's just work out what would happen on this first leg. So we're agreeing to sell our shares for 322, which is a 45-cent move to the upside. So we're going to pocket a 45-cent profit if we are exercised on the underlying, plus we get to keep the call option buyer's premium, which is at 64 cents. So we stand to make on that first leg a maximum of $1 to the upside. Now, what would happen to our long put option, and what does that mean? So we are buying the 321 put, and we're paying a premium, an option premium, or a debit of 58 cents. Well, that means there's another counterparty, usually a large bank, who's willing to purchase our shares for 321 a share, no matter how low the SPY goes. So that's why we call these trades atomic bomb proof. Speaking of which, little Kim over in North Korea has been getting very antsy to get sanctions removed and to make progress with the deal with the US, but that's stuck behind phase 2 of the China trade deal. So there's a lot of rumors that he might be firing off some missiles into the New Year's. So we'll keep a close eye on that. But regardless, it would not change our strategy, and we would never, ever have to have some sort of frantic move to exit a position. You can rest assured that no matter what happens, you will get 321 a share so long as you have one contract per 100 shares of the SPY. So if we were to now consider the effects of the market dropping, and we only look at the two legs that we've discussed, let's look at what may happen. So if we sell the 322 call option and pocket 64 cents, and the SPY were to travel significantly lower, well, that call option buyer is going to lose all of his money. We'll be able to buy that back most likely for a penny. Okay, now what's going to happen on our 321 long put option? Well, that's going to save our butt. So the underwriter, the big bank who sits there and writes this on all stocks at all times, it's part of their business model, they are going to keep our 58 cents and pay us the 321 per share. So that's a 55-cent loss on the underlying. But you got to realize what's cool about this setup is the downside premium, that 58 cents, was covered and paid for by the 322 call option we sold. So we're essentially, by placing that combination of trades, getting absolutely free downside protection or insurance on a big portion of our portfolio. So 40% of our total nest egg following this strategy is protected for free. And so what kind of world can you live in where you get free downside protection? That's quite a deal. Now, to not miss out on the big gains we're expecting, we have to add a third leg. And this is only possible when the volatility index is low. And right now it's very low and most likely going to get even cheaper. So the VIX is a good measurement of the relative cost of options. And so right now, buying call options is a great deal, especially if you believe low interest rates, quantitative easing, and a ceasefire in the trade deal will equate to a bull market in equities. So we're buying a slightly longer duration, December 30th, 2019, 323 call. So let's talk about what happens in a melt up, just theoretically. Well, the short call is going to lose value. So we're going to actually lose money on the 322 call. The put option, which we have purchased, is also going to lose value. The underlying asset's going to appreciate, and our long call option will generate a profit. So if we're correct with our market prediction, you can expect your underlying asset will appreciate and go up in value. Unless the SPY goes up significantly higher, probably $2, $3, $4, you're probably not going to be exercised and assigned. Now, if you are assigned, it's nothing to freak out about, but you can immediately exit your put option if you like, or you can wait till the next trading period for my instructions to do that. But you're essentially going to be making the bulk of your profit from that spread we have from 321.55, the current trading price, to the 322 plus the premium we're collecting. So we're going to generate a profit on the first leg. The second leg, the put, will lose value, and the third leg will generate a profit. So I'm going to go to the risk graph so we can look at this in a little more detail. And so let's just look at our downside risk. So you can see the downside risk is pretty sharp. We lose money pretty quickly, all the way to 321 at about a 75-cent loss. And that's because our put option's not really kicking in yet. And that's because we've purchased that 321 put. So all the way to 321, we're going to be generating a profit on our short call, our underlying assets losing value, our put option's almost ready to kick in and provide value, but not quite. And that long 323 call option we purchased is going to be losing value. But you can see once we get to 320 and then to 319 and then to 318 and any amount further, our maximum loss is cut off at $1 or $100 per contract. But on the other side of the coin, we can see substantial profits to the upside. And you will note that there's two lines. This chart has a hard time understanding time premium value that will be left over in the December 30th call option relative to the trade that's on the 27th. So we're going to have a little time premium left on Friday on that long call option that can allow us to slightly outperform the SPY to the upside, so long as we're getting around $1 plus move to the upside. So we're actually trying to catch some really big gains in our portfolio while mitigating downside risk and volatility. So if we do look at what would happen if the SPY traveled to 323, that's a $1.50 move to the upside. You can see we're slightly underperforming. If you go over to the right, it'll be around a $1.40 profit right there. But if we get a little bit higher and start traveling to 324, that's a $2.45 move, and we're sitting on a $200 profit per share. So let me pull up that risk graph so we can actually look at it in real time better. Okay, so if we look at this and measure a $1 move on the underlying, you can see we're sitting on a $109 profit. So we're just slightly able to outperform the SPY so long as we get around $1 move to the upside. Now, if we're trading around 10 to 50 cents or anything less than $1 up on the SPY, we're going to slightly underperform the performance of the SPY. So that's just a little difference in the loose option caller versus this hybrid trade that's taking advantage of low volatility and the potential for a melt up. Okay, let me take a quick break and make sure everyone understands the trade. We're up to 20 people live. Thanks for joining us. If you do feel like you want to review this presentation, just realize after the webinar is over, wait about 30 minutes go back to the Trade Alert video and click on that link, and there'll be an automatic replay ready for you, where Dean does present a great introduction and overview. Okay, so let's go ahead and see if we have any questions out there. And I will unmute the crowd and see who we've got.
Oh yeah, really good crowd for this being Christmas week. Very nice.
Yeah, 20 live. Welcome everybody. A lot of email guests joining in. If you did join from the Trade Alert email, do realize an hour before the Trade Alert comes out, we do provide your webinar access link. So that one will actually get you in a little bit earlier, so you can get some of the better commentary, and also we'll know who you are. If you do join from the Trade Alert email, right now it's just a email guest is the way it's comes up. So please feel free to introduce yourself and let us know where you're calling in from and ask any questions.
All right. And thank you, Ronald Brooks. Thank you for saying hello in the chat box there. And Jason, did you see the question about the risk graphs? I had to step away for just a second, so I just wanted to make sure you saw that.
Let me look.
Is in the chat box. It just said, can you explain the risk graphs new to the graph?
Sure. Yeah, so the risk graph is pretty cool. On the x-axis, which is just kind of panning left to right as if it's the horizon, this is showing you what price the SPY will be at in the future. So it's saying, okay, if you're hit 323 on the SPY or 319 on the SPY, what's the outcome of your trade alert? And that's calculating everything from the change of price of the SPY to the change of price in each leg of the option. So as you can see, if the SPY travels to the right on our x-axis or goes up in value, our risk graph is showing us we're generating a green profit. So if we do go over to the y-axis and look at this column on the right, this is telling you your profit loss. So you can see that we have an unlimited profit to the upside. And this really makes it stand out. Now, I'm not expecting us to hit a $10 move on the SPY this week, but you can see we have unlimited upside, yet our downside risk is extremely limited. So where's the weak point in this trade? It's about the first dollar move up. We're going to underperform the SPY, but after that, we can slightly outperform it. And if there's some sort of fiasco that causes a huge sell-off, and it could be as simple as some profit taking going into the close of the year, we're going to have very little risk to the downside. So it's a really sweetheart deal that takes advantage of low volatility.
Nice, thank you, Jason.
And the dashed line versus the solid line is it's trying to do its best to give you an idea of time premium value. So because this little guy gets quite confused when you give it different expiration dates. And so the whole goal here is to be up by over $1 come Friday on the SPY and have that very juicy, longer duration 323 call option, having time premium and really generating the bulk of the profit. So that's how we can outperform the SPY slightly and then also have downside protection.
Hey, hi, I have a question.
The dotted line, the dashed line will be the one. Go ahead, please.
What's the difference between the dotted line and the solid blue line?
Right, so that's trying to indicate the difference between the December 27th trades and the December 30th trade. So just focus on the dotted line to keep your life simple.
Okay, I see on your graph, it's the 0 on the y-axis, and cross-axis is 321.39. That's where the cross point is. Does that mean your break-even point is at that 0? at the price of 321.38.
Watch, let me do this just so you guys get a little bit of a better feel for this. I'm gonna make all the dates the same. So options are a little difficult to articulate into the future, like this graph is trying its best to do. It can really, what it can calculate very well is at expiration, after all the time premiums eaten up, what our results would be. But when we start having time premium and the implied volatility makes the options go up and down, it does make it a little more difficult. So yeah, I think what you can expect is if the SPY goes up for less than $1, you're going to see a slightly smaller return than just being long the SPY. If it does go up by over $1, then you can actually slightly outperform the SPY with this trade. On the downside, it's quite accurate. And that's because the second we get below the 321 put, our put options in the money, and that's a very clear-cut formula for it. So really what you should know going into this trade is that we have a maximum loss of $1, which we hit somewhere around, the SPY has to crash substantially for us to even get that. So look at this. The SPY would have to crash $4, actually $5 for us to hit the maximum loss. And that's because it's trying to calculate when your 323 call option would have a value of 0. Okay, so buy and hold investors would be down, in this example, $5.37. And our position will only lose 94 cents.
And why do you say that's the maximum loss?
Because we have
94.60.
purchased the 321 put. So that means the underwriter is willing to pay us 321 per share because we've purchased that 321 put, and we financed it by selling the 322 call. Now, where do we lose if this goes down below 321? Well, that 323 call option you purchased will lose its value. So it loses most of its value in that very quick move to 321. You can see we lose money quite quickly. Now, again, we're still not losing it as bad as everyone else because we have a put and we've sold a call.
If I'm new, where do I get this kind of risk graph?
What broker are you currently using?
TD Ameritrade.
Oh, cool. So yeah, if you have the Thinkorswim phone app, that's what I'd recommend using. And it will actually give you a risk graph right when you're placing the trade. Now, in terms of teaching you how to build your own risk graphs, that would really be part of our bootcamp program. This is really the, how do you put it, Dean? We do all the work for you and put it on a silver plate service in the advisory. So if you do want to learn how to get really technical and fill out the spreadsheet and learn how to design these on your own, then I would recommend definitely joining our bootcamp program. But in terms of what I can provide you today is I can walk you through the trade, what the outcomes look like, and explain the reasoning behind the trade.
Yeah, and I just checked really quick, ma'am. If you do want to look in your Thinkorswim desktop platform, just click on Analyze and then Risk Profile.
Okay, so their risk graph is different from yours. Is yours customized?
No, it's the same. It's going to be the same metrics. There's nothing customized here at all.
Oh, okay.
Yeah, it's a simple tool. Literally every single brokerage on the planet has. But yeah, and I think folks too, the reason why
the problem is with that one though, Dean, they're going to have to be buying the SPY in that same order. Otherwise, it may not quite understand the whole position. So
right.
what I've noticed is it will show you a risk graph but it's going to be relative to only the trades you're actually putting on.
Mm.
So yeah, I think if you did want to call Ameritrade and ask them to walk you through building what you see on the screen, they'll certainly help you do that for free. They have a great tech team and can teach you how to use their platform.
Oh,
Yep.
okay, thank you.
Yeah.
But yeah, I mean, this is not super fancy. So we're buying the 321 put. So essentially our losses, at least on the underlying asset, are cut off immediately at 321. So you guys are probably wondering, well, why does it continue to drop off for another 50 cents? And that's because, look, the 323 call option costs how much? 51 cents. So the underlying asset, you stop losing money at 321. Why? Because we've purchased the 321 put. Okay. Now, why is that going to lose 57 cents? Well, that's how much we're losing on the premium. So 321, the underlying asset stops losing money because you have the 321 put. To get to the maximum loss, you have to go significantly lower. And we're seeing that's approximately another $5 lower. And at that point, we're not losing money on the underlying. We're losing money on our 323 call option. So that call option will reach a near zero value after we've traveled to 316. So if you think about it, buy and hold investors are sitting on a huge potential loss if the SPY were to sell off suddenly. But on the other end, in our strategy, we get cut off at $1. So it's just as simple as that. You cannot lose more than $1 per share on this trade. That's all there is to it. If we go up, we're going to be generating a profit. The first dollar or so, you're going to make a little less than the SPY. But if we go above $1, above the 322 call we've sold, we start to outperform. And so again, this takes advantage of low volatility, and it really gives you the best of both worlds. Very strict downside protection, but you're not going to miss out on a big move to the upside. And I know a lot of you want to know where the break even, it's hard for this to calculate the exact break even because as volatility changes and time premium changes, that's a moving target. And so it doesn't know we're going to close this out at a specific time in the future. It doesn't know what the volatility will be at that point. And so it's just not intelligent enough to predict that. Now it does have some, I do have some more advanced things where I can try to predict what the volatility will be at that moment in time. But those are very complex. To make your life simple, just know downside at 321, we really see a fall off in the sell off in the maximum loss. So after 321, we lose very, very little. On the upside, we're going to need to get above that 322 call option we sold to start outperforming. And if we just simply travel up, we're making money. Does that make sense? Any questions out there?
Thank you.
And so, yeah, you don't want to stress yourself out. And look at that. So you can see no matter how low the SPY goes, because you purchased that 321 put, you have the same risk. But on the upside, you have unlimited upside.
Yeah, and folks, it's just a simple way to quickly calculate and visualize your kind of risk to reward too. So that's Jason's kind of reasoning and showing everyone that too. So it's kind of quick.
Okay, great. Let me go ahead and show you guys what I believe is going to happen in the markets. But first, are there any other questions? Everybody crystal clear on the trade? Okay, great. All right, so let me pull up some charts. So this is a pretty hard to believe move in the S&P 500 since 2008. It's been driven by primarily from 2009 to 2013, 0% interest rates, which fueled a massive amount of spending at the government level, which has been feeding into the Fed, dramatically expanding its balance sheet. 2018, they tried to raise interest rates and sell off some of their portfolio. And we saw what happened. 98% of all assets ended 2018 in a bear market. So they went right back to lowering interest rates in 2019, and now they are firing up quantitative easing. It's the playbook that they've used over and over again, and they're really at the last shot. So quantitative easing most likely will drive equities much higher. So the lower interest rates are, the more bullish stocks are. And that's as long as your government is giving the central bank a reason to expand its balance sheet. Luckily, all the governments are spending a lot more than they make. So this is forcing the central banks to expand their balance sheets. So our prediction into 2020 is relatively simple: melt up in stocks, as long as China is not causing any sort of ruckus with the U.S. trade war. And it looks like they're not. It looks like they really just want to purchase some agricultural products and stop getting this negative publicity about their country, about their re-education camps, about Hong Kong. So they've got a lot to lose. So we'll see if that continues, but it does appear like they are going to purchase agricultural products. So the big move on the bond market, which we did well with in most of 2019, is quite likely over. And I believe this is what will crash stocks. Let me get this on a monthly view. As you can see, the TLT tends to drop very quickly when periods of a scare are removed. And so my expectation is for the TLT to tank to around 120. I don't think it's going to go as low as we had in 2018. To get that low, we had to have the Fed essentially indicating future rate hikes. So they've been hiking rates in 2018 and also at the same time selling bonds, which was extremely negative for bonds. And that eventually crashed the stock market. The whole system is more leveraged today, just a year later, than it was in 2018. So that's why I don't think, and we also don't have a Fed that is going to be hiking rates. Right now, they're just paused. So I do think probably the maximum sell-off in the TLT is between 115 and 120. So we can make a lot of money predicting that move with our inverted option caller on the TLT. So that trade just went into the money since we've been on this chat today. So we're up on 3 out of 4 positions. Gold is coming in soon. I'll cover the gold and emerging markets in a minute, but my expectation on the TLT is, again, for it to tank to 115 to 120 level, and this will cause a stock crash, and essentially the Fed's going to have to come in and say, all right, we're cutting rates to 0. That will give the bonds the final push, which I believe can go all the way to about 180. And that's based on looking at where German 30-year yields have gone into negative territory and predicting we can get our 20 and 30-year treasuries not in negative territory, but significantly lower than they are currently. So let's go look at the yield curve. Boring, but probably the most important thing for you guys to know about right now. Let's go back in time a little bit to the last stock market crash so we can see visually what happened with bonds. Okay. Let me pull that up first. So 2018, it's kind of a weird year. We had emerging markets selling off, but US equities doing well. Let's look at what happened to the yield curve as stocks rose into 2018. I'm just going to do every other month. And so you can see what's happening. And so just quick explanation. On the x-axis, we have the duration of the bond. So you have your T-bills in the front end of the curve, 1 month, 3 month, 1 year. Your notes, the 2-year, 3-year, 5-year, 7-year, 10-year, and then your bonds at the 20-year, 30-year. So if you've heard the Fed or Powell tell you that he's not doing quantitative easing, the reason they can justify that is because they're only at this point in time purchasing the front end of the Treasury curve. So they say as long as it's not the medium or long-term debt, that they're not distorting the bond market. So what happened during the 2018 rally in stocks? Well, yields climbed. And so the one that a lot of people like to focus on is this 10-year. So if we do look at that 10-year, it climbed from 2.66 to 2.68 to 2.78. Let's add a few more data points. July, it's getting really high, up at 2.96. September, it jumps to above 3%. Now, why is this significant? Well, if you're investing in stocks, we all know how risky that is. It's flying up and down, left and right. We got a trade war. So there's a lot of risk entailed in owning stocks. But if you purchase a 10-year treasury, you're going to get a 3% return, and inflation's below 2%. That's a 1% guaranteed profit for your bottom line for 10 years. So that's very hard to turn down. And from a banker's standpoint, they know what happens next. Anytime these yields get too expensive, it causes money to flow out of stocks and into bonds. And when those yields get out of control and do cause market disruptions, the Fed has a pretty clear strategy, and that's to cut interest rates, which is exactly what they did going into 2020. He'll be known as the Powell pivoter in February. So let me delete some of these points and we'll see what happened to our yield curve immediately after. So like clockwork, the bankers jumped on those high yields knowing two things would happen. One, a guaranteed profit. At the worst case, best case, the Fed's going to have to save the stock market by cutting interest rates. And so what happened to our good old yield curve after that? Well, you can see today, rates have gone down extremely low, but let's look at the immediate aftermath going into this crisis. And so you can see those yields dropped the second they got so expensive, and at the same time, stocks were crashing. So that's really the basis of our strategy, is understanding the relationship to stocks and bonds. And so my forecast is that almost identical to what happened in 2018 is headed our way in 2020. Now, I don't know exactly when we're going to get to nose-bleeding levels on that 10-year treasury, but currently we're sitting at 1.92. Now, Bank of America is projecting that most likely 2.8 on the 10-year will be what cracks the stock market this time around. So we'll see how long it takes to get there. But that's significantly higher than we are currently, which means we could have a vicious sell-off in the TLT. So that trade's now in the money, and you can see when it really starts to sell off, it sells off rapidly. So this is a very, very excellent opportunity to generate profits on our Thursday TLT trade. Okay, so that's what I see for stocks and bonds. Now let's take a look at a few other charts. So emerging markets, a little bit of a tougher call. I don't want to be short emerging markets when we're in a period of peace with China. The biggest chunk of emerging markets is China. We know they're really slowing down rapidly. Their 6% GDP growth is what they're targeting in 2020. And as long as people aren't messing with them, they can generate whatever GDP they want, because they're simply printing money at the Bank of China, lending it to their own people who are purchasing their second, third, fourth, fifth house, where they're controlling the prices. So it's quite a scheme, and they can easily control that as long as, again, they're not having external pressure from the US. So at this point in time, we're betting up on emerging markets because of quantitative easing, low interest rates, and a lot of money freaking out in negative yielding bonds. So there was at a high point $17 trillion that had purchased negative yielding sovereign debt. And now those bonds are underwater. And I think we're going to have a panic of people trying to get out of worthless bonds. Without a fear mechanism, the short-term outlook for being long bonds is scary. And so they're slowly seeing that unwind right now. And so we can also obviously see this beginning to occur in the long end of the Treasury already. So those rates are starting to climb. And so if you think about it, if you purchased a bond with a negative yielding interest rate, well, you're guaranteed to lose money for the entire duration of that bond unless rates go significantly lower. And currently, the exact opposite trend is happening. Furthermore, we know that Trump wants to win the 2020 election, and he can't do that most likely if the US is in a recession. So from that standpoint, I believe that we can have a period of a ceasefire in the US-China trade war, and that's going to be very scary for investors who jumped into negative yielding bonds, expecting that this would never stop climbing higher. So I do think in the long run that we will see much lower yields and a much higher TLT, but not until we get to that 2.8% on the 10-year and cause the stock market to crash from that. And so that's what will cause the Fed to cut interest rates. And the expectation of interest rates being cut are what really drives bond prices. Now, a lot of people think the bond market's telling the Fed what to do, but I would argue that really it's the bond market's trying to predict what the Fed will do ahead of time. And so right now the bond market's clearly predicting that the Fed's going to stay put and that these yields need to rise. Okay, so let's look at GDX. We've been playing spot gold for most of 2019, did well, but rotated into GDX once it became clear that we're not in a business cycle or a cycle with the Fed where they're going to be hiking rates and doing quantitative tightening. Now, remember, in 2019, Powell was very strict about saying that it was on autopilot and that they're going to protect us from a recession in the future by getting those rates higher and getting control of this huge balance sheet. If you remember, Ben Bernanke and Janet Yellen told us that these are all short-term fixes, this huge expansion of the balance sheet. Well, of course, that was not the case. Now, what happened the last time we did massive quantitative easing? Well, just go to 2008. You can see GDX didn't do very well with rate cuts, which is what we had leading into the crisis. But once they did the quantitative easing and stopped the rate cuts because they're at zero, what happened? Well, stocks and gold stocks both rallied rapidly. And so you have this insane move from $20 to 63 in the last crisis. And that was just from a small US housing bubble, which is much, much less of a problem compared to where we're at today, mainly because of China's malinvestment in real estate is starting to play out in the global growth scene. So my expectation is we're going to see quantitative easing in 2020, at least for the first 6 months. And you couple that with US government and fiscal spending at all governments really being out of control. This is going to force the Fed and every other central bank to increase its balance sheet and support these primary dealers who have to buy the government debt. So really, either the governments need to cut spending and crash their stock market, or the central banks have to start buying up government debt and expanding the balance sheet. So I think right now we're going to see a lot of quantitative easing going into 2020, and that will be extremely bullish for stocks, including the gold miners. Now, what could be the big punch for GDX? That would probably be more towards, I think we could see a decent gain in GDX in 2020, but I don't believe we'll see the big, massive rally until they officially cut rates to zero and start moving from the front end of the treasury towards the middle and long end, which I think's in the books for probably Q4 of 2020 or Q1 of 2021. Okay, so that's a review of the charts, the yield curve, our trade alert. Let me take a look at our open positions and then we'll go to Q&A. We're up slightly on emerging markets. We're just simply long a put until January 10th. This allows the underlying asset to deliver the bulk of the profits. We're not as aggressively bullish on this position as we are on the SPY. So we're just essentially entering our maximum loss with the put right when we enter the position and then allowing the asset to appreciate. So it gives us a low volatile strategy to benefit from a move up. TLT is actually below our entry point, which is good because we're doing the inverted option collar. So this will profit from a down move in the TLT. So we should see in tomorrow's update that this is in the green. And GDX needs to get a little bit higher. Same setup. We bought that in the money put. So we have to pay off the put to generate the return. This is another way to have a low volatility strategy to benefit from GDX, which I think will appreciate in 2020, but I believe its biggest fireworks will be after the Fed does capitulate down to 0% rates and moves off the front end of the curve into the middle. And so if they start to do that, people are going to get worried about inflation, and that's when you really get the big moves in gold. All right, Dean, I am through my presentation. Should I put it back on your screen now? Let's see if we have any questions. He may actually be on a call, so we'll, oh, I think he's back.
Hey, Jason, thanks, bud. Yeah, sorry, I was getting unmuted there. But yeah, any questions out there, folks? Actually kind of touched on everything previously, so.
Pretty good. Okay, great. Well, yeah, let's just see if we have any questions and then we'll let everybody get to their holiday festivities.
I have a question.
Sure.
On Thinkorswim, would this, you'd put all four of these together and just do a blast all? I know it's more of a platform question, but.
You want to replicate the risk graph?
Yeah, I did that. And then when I want to make the order, I just copy all four of those orders into the order entry and then under a blast all.
Yes, sir. Yeah. So let me pull up my order ticket. This is like a really simple version of Thinkorswim, which I really like for illustrating the trades. But yeah, I use Ameritrade as well and the Thinkorswim phone app specifically. But yeah, here's your exact ticket for the options. And this assumes you already have the 100 shares of the SPY. So if we were to see if I can add, I'm not sure if I can add the stock on this one. No, it'd have to be a little different. Okay.
But yeah, great question, Mark. And if you want to have TD Ameritrade / Thinkorswim walk you through how to do that, if you don't already know, feel free to call them. That's what I do on my side.
But yeah, you do need the 100 shares of the SPY on top of the 3 legs of the options.
Yep. Okay, thanks.
Yep. Any other questions out there?
Yeah, I have a question about last week SPY's trade.
Okay.
When you calculated the profit and the losses.
Sure.
My question is, last Wednesday, since you sold out the you sold the SPY, so but you gained the profit on the option trade. So when you calculate the profit, should you account for the you did not get you didn't get the gain of the SPY went up because you
Correct.
sold it.
Yeah, and we did fix that on the webinar, so that's a good catch. Here was your profit from Friday after I realized the mistake on the calculation. So this one was really easy. We only had to calculate the cost of the option. And so what's neat about when we do this version of the trade, you can do it with much less capital. All you needed was $100 to follow that trade. So essentially you paid $102 per contract, and then you sold it for $2.77 or $277 a contract. So from that basis, you're up, what is that, 170%. But with our strategy, we're not recommending people get that leveraged up. And that's another reason why I typically don't design the trade where we're selling the put, because this would allow people to be a little reckless with position sizing. Because you can see, you could come into this trade with $100 and be up 177 and start, going all in on our trades, especially when you see how often we've been winning on the SPY, and that's not the nature of this program. But yeah, you're right, and I did realize that live. That's also one of the reasons why I've stopped calculating the monthly returns on all 4 positions every day and gathering so much news. I'm doing that now on the weekend and sending it out separately so that I can really be 1,000% focused on that trade alert that day and to have no mistakes. So I'm literally reading the trade alert about 20 times before I let it go out now.
Hey, Jason.
Mm-hmm.
My question is on this calculation, should you include the gain, but you did not get, as a negative to this calculation?
So on Friday,
because you sold.
Originally added in the value of the SPY going up, which is our normal calculation, but we didn't own the SPY. We simply had the option. So all you had to do on the previous trade was know that what you paid to enter, which was $1.02, and then calculate how much you got back.
So you don't put the SPY, the portion you did not gain.
Yeah, let me walk you from the Wednesday trade to the Friday trade so you can see that clearly. Because that was an abnormal, we took advantage of the dividend that was going to be issued. So rather than be very aggressive to the upside, we had tremendous downside protection on that trade. So let me just pull it up and I can walk you through it. So here's a trade on Wednesday. Let's pull it up. Step 2 said that this got you out of the previous trade. It says sell all shares of the SPY ETF. Then for every 100 shares of the SPY you originally owned, enter one of the following multi-leg option contracts. So we sold the 318 put, which was $2 below the trading price, approximately. And so to collect 73 cents with that far of an out of the money put is not normal. The only reason why is because the dividends were going to be delivered that day. So we sold the 318 put, we purchased the 316 put, and then we purchased the December 27th 319 call. So in this trade setup, you could be following our program with $102. Which is attractive. If you're a smaller account size, I could see why you might really like this trade setup. Now, the problem is people might take this and get too aggressive, and that's not the design of this program. So we're trying to safely generate returns at around 1% a month. Now, if we make 2 or 3% a month safely, I have no problem with that. But what I don't want to do is put ourselves in a position where we could be losing a large amount of capital. So all you had to do really for this trade is here's how you entered it. Let's look at how we exit it. That'll be step 1 in the next trade. Okay, so we had to, in fact, I'm going to copy this trade and put it side by side so you can see it together, okay? Okay, so here's the original order, and here's how we got out. This was on Wednesday, and this was on Friday. So paid $1.02, and you got $2.77 back. Does that make sense?
Yeah, I don't have a question about the gain and loss on the option. I'm saying if you hold on to the stock, you could gain some money because you sold. Would you account that for as a negative when you're calculating the profit?
In this,
That's my
trailer,
question.
I instructed you to exit the SPY.
Yeah.
But if you had held your SPY and did the option trade on top of that, you did even better. So you would have actually had an additional profit to report, which would be $319.90 when you entered, or at least at the point of entering the option trade. And then at the point of exiting the option trade, the SPY did appreciate by
Right.
significantly. So if you did hold the SPY and ignored the instructions to sell the SPY,
Mhm.
you did outperform.
Okay.
Okay.
All right. Thank you.
I'm gonna go ahead and pull that back just so we don't mess up our historical archive. All right, guys, any other questions? Thank you so much. I really appreciate questions. It makes the whole webinar go much more interesting for all our listeners. We still have a few email guests live. Do you have any questions? You want to unmute your mic? All right, guys. Well, tomorrow we will have a early webinar at 10 a.m. Eastern and an earlier trade alert. So we'll get you guys into the emerging markets if you haven't had that position yet. I'm gonna go ahead and put up our risk disclaimer and close this out. Appreciate everybody joining us live today, and we'll see you tomorrow.
All right. Thank you, team. And once again, 505-322-7515. If you have any additional questions after going through the webinar, be more than happy to help you with that. Okay.
Great. Thank you so much, team.
Absolutely. Thank you, Jason. Wonderful presentation. Enjoy it.
Great. Thank you, guys.
Thanks, Ron. Have a great night.